Okay. So as I mentioned, we wanted to talk about this being June, mid-year. This is often a really great time to think about a portfolio check, review, edit. So we wanted to do our discussion this month on the mid-year portfolio edit, including how do we know when and how and what kind of changes to make to our portfolio. Um, our same disclaimer as always, this is a presentation and a discussion at a general level. We're not personalizing this for any single attendee. So this is not meant to be financial advice. And I want to start by talking about the portfolio picture. So, what do we even mean when we say portfolio? And I want to be clear that we're not only talking about one particular account. I think it is important to look at the big picture of your assets when it comes to your portfolio and not to have a really siloed view, especially when we talk, and I'm going to talk a little bit more about timing of when to have these conversations with yourself or your partner or whoever else you might be making money decisions with. Um, but when we have reviews like this, it's really important to be able to look at this from the big picture and not just one particular account or one or two particular accounts or assets. So our portfolio includes our savings, emergency savings. It includes retirement accounts, brokerage accounts, as well as other investments like real estate, businesses. Typically, I don't kind of bring the primary home into portfolio, big portfolio discussions, unless there is a really dedicated role that your primary home is playing ultimately in your strategy. So you might have a plan to sell that home or pull equity out of it in a certain number of years and do something with that equity or with that sale. And that might be a reason to bring in your primary home into the portfolio discussion. But I often, draw a line between the primary home and the rest of the portfolio because primary home is not an investment. It's a place where you live. It's very functional, and you're going to want a place to live forever, presumably. So unless there are exceptions to that, typically a primary home is not brought into this portfolio picture. And let's talk about the schedule too, because I want to emphasize, especially if you're a passive investor. And when I say passive investor, I'm not like, I know in the real estate sense, we talk about passive investing as far as like investing into a general partnership as a limited partner, or versus, doing your own real estate deals. And when I say passive investor, I'm talking beyond real estate. I'm talking about public markets as well. And typically, our, our philosophy is passive investing beats active investing most of the time. And that means, we're not suggesting that anybody should try and be day traders or that anybody should try and time the market. We are talking about building passive portfolios using index fund strategies and really being able to sit back and take advantage of stock market returns that have historically happened that we expect to continue to happen in the future. And in that theme, less tends to be better. So when we wind up looking at our portfolios constantly, we're more likely to worry about them and to try and make changes. So it's a great idea that once we have a strategy dialed, an allocation dialed, that we really can set it and forget it. And these reviews are not meant to pressure us into making changes. They're really just meant to allow us to kind of check in on a few key things in our life. And I'm about to mention what those are. And those are the things that are really relevant when it comes to having a financial plan and when it comes to having an idea of what our allocation should be. So when we talk about doing a portfolio review, we named this discussion the mid-year portfolio edit because this could be a good time to do a yearly check of your portfolio. And that's where we're really just being strategic and understanding, Do we have any big rebalancing to do? Rebalancing isn't something that we should have to do very often, but there could be some reasons why we might need to do some rebalancing, and we'll talk about what that is and what might need to occur when we do that. But that's what this yearly view is all about, is really just kind of checking, is there like a big rebalance that needs to happen? Something got out of whack and we need to fix it. And by the way, fixing it doesn't happen right away. It's something that probably should just happen slowly over time. And do we need to check on our goals and our long-term plan and make sure that those are still relevant to everything happening in our life, everything that we want? And so yearly is a great time to do that. Of course, there are some exceptions. When it comes to quarterly, I always think that this is more optional, but it's a quick balance check. This is something to just kind of keep us just aligned with what's happening. Ensure that the market hasn't caused like a massive allocation change, which shouldn't happen very often. But I'm curious to hear if people on the call have a different pattern. Who's checking a portfolio more frequently, less frequently? And does this sound scary to sit back and say, this is something that really we can do this on a yearly basis, and then there are a couple things that we can do, on a slightly lower level, maybe at a quarterly basis.
I think it all depends on where you are in life and different milestones that are happening. But in general, um, that's been my approach, kind of set it and forget it, kind of, and just be comfortable with the fact that there was a long runway to make up for any undulation that occurs along the way. But right now, for me personally, I'm in a period of transition where my runway, I think, is still kind of long, but it may be going to a different airport or changing a little bit. So I think because I'm making some changes, I'm checking more frequently, probably unnecessarily so. But in general, yeah, I like to set it and forget it.
I'll say for me, my retirement is definitely set it and forget it because it's a long runway. Like you were saying, it's just buy and hold and just let it sit there. My taxable brokerage account, since I'm living off of it, I'm doing a little bit more of the tactical asset allocation based on what's happening in the economy right now. Um, it still is probably at least half just, low cost index funds, but I'm also doing some other things to try to take advantage of different things that are moving in different directions right now, and also trying to take inflation into account, some things that we weren't really expecting at the beginning of the year, right? It's, I guess, another good reason to do a mid-year review. If you had asked me in January, what were interest rates going to do? What was inflation going to do? It would have been a totally different answer than where we're at now. So I think that can definitely come into play and could be a good reason maybe to do this mid-year review of the portfolio.
And you mentioned inflation, Susan. Are you finding that's because your cost of living, you're seeing it rise, you're seeing that you're having to withdraw a lot more? Or are you talking about wanting to hedge against that inflation and make some changes to counteract?
Yeah, so I'm kind of doing some of both. I'm shifting my portfolio a little bit to hedge against inflation. And then also, I am seeing our expenses go up, especially like our insurance policies are renewing right now, and they're like doubling. And so I'm like, okay, well, I've got to kick up these dividends a little more, figure out what I'm going to sell this year. How can I do my tax loss harvesting to make it all work out by the end of the
Hmm.
year? And I've already done a lot of tax loss harvesting to the point, and now, the market's been going up. I'm almost out of losses to harvest, which is a great problem to have.
Yeah,
But
yeah,
but I also have to account now for taxes, right? If I sell anything else to pay for stuff. So
right.
that's been a reason I've been in my account more often than usual, looking at things and trying to figure out, can I structure this a little better from a tax perspective too?
Yeah, yeah, that makes a lot of sense.
Yeah, I think my answer is and Susan, that was helpful. Thank you for sharing that. Um my answer is I think whenever something like active, whenever there's like a an opportunity or a decision that I need to make that sort of comes at me actively, then that's when I go like, okay, well, what is the rest of like what's my position overall? So it's like I'm not really in a regular cadence to just look and calculate everything, but whenever I'm deciding about a new move that would come up, that's when I'm sort of like, okay, well, how are we doing on the rest of everything else? Can I do this move? Should I do this move or not? And then if something else seems out of whack, then that's probably when I get to adjust or rebalance something. But yeah, I think that I'm recognizing that it's more of a as a decision comes up is probably my trigger, which is probably not as good as having, like set times, but at least I'm doing that.
I no, totally. I think that
Yeah.
that's spot on. And you both, I think actually everybody mentioned when it's appropriate to make exceptions to this schedule. And it sounds like people are like doing this organically, even if it's not an intentional, like, oh, things are different. I have to go back in here and check. Um, but I think each one of you really hit on all of these. And like for me, I can talk personally to this third bullet of unusually large or unexpected expenses. We're selling a home right now. And it's the whole you gotta spend money to make money. Like we've put a lot of money into listing this home and into the sale of it, and it hasn't sold yet and we're not expecting it to sell, probably in the next few weeks. So it's money that we're spending. And um, so I have found myself checking my portfolio a lot more often to figure out, like, yeah, or am I going to harvest some gains? Am I going to harvest some losses? The sale of this home is not going to result in capital gains for us because it's a home that we lived in the last few years. So we are not in a position where we're going to get a lot of gains from the sale. And therefore, I might be, this might be an opportunity in our lives to take more advantage of the gains that we have in our portfolio because who knows what it's going to look like down the road. So rather than harvest losses, I'm leaning towards harvesting gains, but I'm being really strategic about what to sell in our portfolio in order to just pay for some of these big expenses that we have right now. And it sounds like people are in similar positions as far as like, I'm in a different phase of my life right now. I used to have all of this regular income and now it's really different. So it does make a lot more sense for me to check my portfolio now. Or perhaps you got to a point where you're like, okay, retirement was always like the big thing, but now as we get closer to retirement or are in retirement, we're realizing other goals that we're wanting to focus on as well. Um, and I love hearing that perspective from you all too. I'm pleased to hear that no one is like a constant checker of their portfolio, which um, I think it's normal to fall into that temptation, but it can also lead to the temptation of making more changes, and it can create more stress in our lives. So I'm happy to hear that there aren't uh, folks on this call necessarily who are checking their portfolios constantly. So when it comes to doing this review, where should we focus? And um, going back to the parts of a plan that are so easy to overlook in favor of, okay, what are the numbers doing? What kind of returns am I getting? How can I go from, 8.5 to 8.75 of a percentage of return, and really where it might not be as sexy to focus, but is so important is going back to our goals. And especially, again, when we're talking about doing this higher level check on a yearly, maybe semi-annual basis, is my money still intended for the same purposes as the last time I did this? So what were my major goals last year or a few years ago? And are they still the same? If my goals have shifted, then I should also look into should my money strategies shift? Does my allocation need to shift in order to reflect this different goal? And an example of that is retirement. Like that's probably one of the biggest cases where we see this having a really big effect on where our portfolio should be is I went from wanting to retire in 10 years to I think I can retire in 5 years and I'm totally excited about that. Okay, so that 5 year shift, that changes things in our portfolio. And it absolutely makes sense to go back in and reevaluate then. Our timeline now is 5 years shorter as far as needing this money. And we're going to talk about timeline next. But based on that shift, what else also needs to shift? So making sure that we're checking in with our goals is really, really important. Retirement isn't the only example. We can come up with many, many, but here are a few more. You might decide you want to start traveling a lot more. Maybe that adds to the amount of money that you want to build up. Maybe we want to step away from our careers or step back a little bit earlier and then go back to work later. But that means, oh, I'm going to have a period of time where I'm going to want to withdraw funds and I'm not going to withdraw them from a retirement account because it's going to be too early and I don't want to deal with penalties. And I have a taxable bucket that I can use instead. So what does that look like? I'm going to actually withdraw more from my taxable bucket in these few years than I was expecting, but I might actually, you know, not tap into my retirement account for longer than I was expected. So how do we reconcile that? And that's where, reviewing our portfolio comes into play. And like I mentioned back there, this all feeds into our timeline too, right? Our goals often drive a lot of our timeline. This is, when do I actually need this money? And I want to highlight here, this is something that I found in my own experience with my own 401k and something that I see also with folks who we work with, which is that a lot of investors, they might be taking too much or too little risk, but a lot of things that we see is we see investors not taking enough risk. And this is like classic 401k or retirement account example is that a lot of times when we opt into our employer sponsored retirement account, we have funds that are purchased for us automatically based on how much money we're contributing to that account. And those funds are selected by the fund manager that your employer is using in that retirement account. And you have the option to override that and you can make different selections. But I'll talk first from my own experience is that when I first reviewed my first 401k, many, many years after I had enrolled in it, I saw that I had a lot of target date funds that were based on a traditional retirement age for me, which actually it was far later into the future than when I wanted to retire. So you would think that it would have, um, you know, even less risk than, or even potentially more risk than I would have chosen. But I found that there were like so many more bonds in that target date fund than I needed. And personally, I think that no 20 or 30-year-old needs bonds in her portfolio unless like there's a very, very specific and unique reason. And so I was surprised by that. And it took me a while to make the change because I just wasn't confident and I didn't think that I was right in having that intuition. But I see this now very often is that rather than being overly aggressive, which is a good thing, it's actually overly conservative is the majority of what I see as far as employer sponsored retirement accounts go. So that's just one example of making sure that you're based on your timeline. Are you invested in the right things? Is your allocation reflecting someone who needs her money like in 5 years or someone who needs her money in 50 years? And based on when that timeline is that accurate? Is that accurate for your needs? And of course, we have different locations of where our money is. So we might have our retirement accounts that we're not planning on tapping into until we're 59 and a half or older. And those, might have one particular timeline, whereas there might be other accounts that we're tapping into sooner, and those should have a more aggressive timeline, an earlier timeline. And our timelines will change too. So just like in the goal that we talked about on the last slide, we might plan to retire at a different time. and that retirement goal might change. So of course, that's going to change our timeline.
And then I guess something else about retirement and your retirement accounts, mid-year is a good time to go in and see if you're on track to contribute the amount that you intended to contribute for the year, that you're not going to overshoot the limit or way undershoot your match. So it's a good time to just go in and check and see what's going on with your accounts and make sure you're on top of that before, it's December 31st and you're realizing, you've done something that you didn't intend to do, right?
Yeah, I love that you made that point here because actually, um, risk is next, but taxes are going to come into this discussion. And one of the reasons why I feel strongly about having reviews and conversations like this before like October, November timeframe is it gives us a lot more of a runway to make changes that will affect things like taxes. And I think that the timeline piece is a great segue to that too, because we can make changes such as how much or how little we're contributing to retirement. And sometimes we should be making those changes earlier than like, October, November of that year. So while there's so much that we like to do from a planning perspective later in the year, once we have a better idea of like how much income did we wind up having, how much income are we likely to have for this entire year, usually we can make those guesses a lot more accurately towards the end of the year. But if we're trying to back up and make more planning type decisions, it's often great when we can do that earlier in the year so that it applies for that whole year. So risk tolerance, very closely related to time horizon, but it goes deeper, right? So if we should be having, a little bit lower and lower risk tolerance as our timeline is getting closer and closer to retirement. So as far as like, choosing the bucket of money that we're going to be using first in retirement, that bucket should probably not be like super aggressively invested in the couple years leading up to our retirement timeline because the more aggressively invested it is, the more volatility we're going to see. And therefore, if we have to start withdrawing that money during a downward swing of that volatility, that's not good, right? So that's why, often our risk tolerance can be tied to time horizon. But what if we are investors who are just not, we don't have a lot of risk tolerance, even though we might have tons of time, we still are not sleeping well at night, knowing that there's going to be a lot of up and down swings and where we've invested our money. That's an important factor to understand. And the reality is that very often we evolve in risk tolerance. Sometimes you can argue that as we get older and wiser, we become more aware of the consequences of our risky decisions. I've seen that play out a lot personally in my life, but also on the other side, we might realize that, okay, I was really hesitant to invest in this thing, and I wasn't sure how I was going to make it through that one recession, but I did make it, and actually I stayed invested, and I'm really glad that I did. So now my risk tolerance is actually getting a little bit higher from experience. So both are possible. Our risk tolerance is really likely to change. And that's why I don't like the idea of us having to attach ourselves to one particular risk profile for our entire lives. I think it's really important that we be open to the idea that that risk profile changes. So that's why I like the idea of making sure that we're checking on this every time we do a portfolio review, because it's important, again, going back to that 401k experience. If I used to be very risk intolerant, that meant, I probably was invested in assets that didn't have a lot of volatility, and that helped me sleep better at night. It also means that I wasn't achieving the same amount of growth that perhaps the average investor might be achieving. And maybe I'm at a point now where I'm able to adjust that a little bit more. So now maybe I can go up a little bit in volatile assets so that I can have the opportunity to have more growth in my portfolio. And that's not something that has to be a big jump ever. We can really, really incrementally make those changes. But I like the idea of bringing this into the conversation so that we can evaluate, wait, maybe I do feel a little bit better about investing in a little bit more growth oriented assets. Whereas before I was really just all about like, give me the fixed income, give me something that's just like a lot more stable. So allowing ourselves to be open to some of these changes is a great thing. And then, of course, on the other end, allowing ourselves to be open to our risk tolerance shrinking. And maybe that means we're not getting the same amount of return in our portfolio that we used to, and that's okay. Totally okay. We should be letting ourselves sleep at night. That is absolutely a big factor in our financial plan. And you know that I wouldn't have a review without really incorporating this values aspect as well. Am I okay with owning what I own? And I can't help but think of Elon Musk here and how he has influenced changes in so many of the markets that are causing us, I think, to be exposed to SpaceX here in probably the next couple of weeks, even if we don't want to be exposed to SpaceX. So SpaceX, whether you no matter how you feel about the man, I personally don't want to be invested in a company that has been only losing money since day one. But there's going to be not a whole lot I can do about it if I keep many of my holdings in assets such as like those tracking the S&P 500 or the NASDAQ 100. Um, so what I'm talking about is if you have index funds that are tracking some of the biggest companies in our country, then you might have to be invested in SpaceX pretty soon because Elon Musk just influenced his way into Wall Street and allowing SpaceX to be on the market, even though there's usually a time limit of at least a year. And he was able to get that down to 14 days for depending on the index. So what I'm blabbing about here just reflects that we we do have some control in what we're invested in. We also don't have control over every single thing that we're invested in. So I want to be careful not to make anyone feel guilty about investing in the market, because I think that first and foremost, if we're building wealth individually, then that allows us to do a lot of things that a lot of our, those who came before us were not able to do. And that is important first and foremost. So if you've gotten to the point where you're like, I got invested and that's my first step right now. And I haven't gotten to the point where I'm looking at exactly what I'm invested in. I just know like I now have a portfolio. I'm like doing the thing to make sure that I'm growing that portfolio. And that is a win. And that's important. And especially women should not be the ones who are most heavily guilted into pulling back from that, even though we tend to be. So I want to be careful not to make sure that any of us feel shame for doing something that is important, which is investing and helping us build wealth. And what we do with that wealth is probably going to be really valuable, not only to our family members or friends or those who we care about most, but also our community. So being invested is really important. If you're getting to the point where you're like, I am not sure how much I want to keep being invested because I don't feel like I have a lot of control into what kind of companies I am supported, there are options. And I've sent out previously like ways to be able to evaluate within the holdings of an index fund that you might be invested in. You can literally look at a scorecard to see like how do the companies in that index rate on this scorecard. And if you're not happy with those scorecards, you also have the ability to make some changes and invest in companies or in funds that are refusing to invest in certain industries and refusing to invest with certain companies. So those options are out there. I always like to say that's next level investing. Okay. So don't let the idea that you need to do that um, exclude you from taking that first step of investing to begin with. So um, I know that this idea of values can be a little bit convoluted for that reason, but I also want to invite to the discussion people who are like, I'm not going to invest unless I know that I can do so with in a way that makes me feel comfortable as far as how I want to see this world grow. And there are options out there. So don't feel like you can't have a seat at the table because the table includes a lot of bad actors. There are also some decent actors.
I will say I actually invested in a fund specifically because they were invested in SpaceX. Um, and it's gone up and down. I had an unrealized gain for a while. I think I'm back at a loss now. I don't know where it's going to go, but it's my play money, right? I'm not going to take all of my net worth and put it in that fund or put it in SpaceX. And so I do think it's okay to give yourself permission to have,
Yeah,
a little bit of money that you're okay losing and invest in interesting things, that pique your interest or that you believe
totally.
in or don't believe in and just want to see what happens, which is kind of what I'm doing with SpaceX.
Yeah,
Fund I'm in, they're invested in SpaceX, Anthropic, OpenAI. Like it's a lot of these, big name companies that may be doing IPOs soon. And so I was like, okay, I'll take a flyer on this. I'll buy 10 shares and see what happens. So yeah, there's Caitlin and I have a lot of discussions about values from like an ethical standpoint versus, well, but how much more good could we do if we built our wealth that much more? And I think
hmm
there are really two different sides to that. If we could invest in SpaceX and make $10 million and use that to educate women about finance, maybe that's a better outcome than not being willing to invest in SpaceX because we don't agree with what they're doing. So, I mean, I think there's definitely two different sides to that. And yes, Caitlin
totally.
and I like to discuss the merits of both sides.
Yeah, totally. And I am affiliate. I mean, I volunteer with other organizations where we try and bring like ethical investing education to all different groups of people. And even with the knowledge that I have, I can tell you, like, I still, and I care a lot about this, but I'm not someone whose portfolio is flawless looking at all. So I always like to like add, the caveat that this doesn't mean if you are an ethical person, you should be investing in a certain way. And it certainly doesn't mean that if you've already decided I want to invest in a certain way, that you have to like divest from everything that you classify as evil overnight. Like that, this is the kind of thing I think that takes a lot of time. And like Susan's right, we've like had really healthy debates over this, and I think that there's not even just two sides. There are a million sides of this, and there's not like any sort of right or wrong answer here. But this is simply a way to know that people have options, and also this is something that Susan and I have talked about a lot is who are the humans who are more likely to be thinking about values and thinking about, wait, is this the right way for me to invest? Statistically, women are more likely to think like that. So if we were to shame the people who had those thoughts out of investing, then what does that do to female investors, right? So we certainly don't want to see women being pushed out of the conversation. So um, I'm not doing a very good job of articulating this, but what I mean to articulate is like, I hope we can bring more women into this world of investing, make them more aware of their investments, and also bring in the women who are like, I know what's out there, and that's why I don't want to invest, and hopefully, even just like widen this audience of women investors. Okay, so allocation check. I actually have a linked spreadsheet here that Can you all see that? I think I just popped
Yes.
into, okay, great. Um, so this is, I just wanted you to see how basic this is. Like when I say allocation, I'm talking about like the percentage of different, like how different types of assets are made up in our portfolio. And if you can see here that this is like one total sample, this is, don't get any ideas as far as like us recommending this allocation, but you could see that this is a total allocation where someone has said, I want to be allocated 30% into US stocks, 25% international stocks, 25% bonds, 15% real estate, 5% gold. And I mean, if you know anything about the discussions that Susan and I have had in the past, you know that this is not either nowhere close to an allocation that either of us would hold. But this, you can add other line items here. Um, this is just an example of, okay, if you were to have this entire pie made up of whatever pieces you want in your pie, this is your chance to say, okay, this is how big I want each piece to be at this point in my life. And you have permission to say, I'm going to change the percentage of each pie because this is something that has changed in my life. Or I'm feeling shaky about the US stock market and I'm feeling a little bit more confident about the international stock market. So maybe I'm going to shave down a little bit of my US percentage and beef up a little bit of my international percentage. Maybe I'm like so done with real estate I'm going to chop that piece out of my pie and maybe I'm going to add REITs here instead. Or, I'm so freaked out by inflation, I'm going to add a lot more to gold, which is not something I would ever recommend doing. But I'm just giving you an example of how some of our beliefs and goals might shape how our allocation looks and then how it evolves over time. And it's, a lot of times allocation is like thrown around and it could be used as sort of a fancy word, but I just want to bring us all back to all it is it's just like the map of how big each piece of our pie should be. How big do we want each piece of the pie to be? Do we want more pieces of the pie? And if so, let's add a desired percentage for that pie, even for that piece, even if it doesn't exist yet. And then we can work towards like incorporating that piece into our pie. And then based on that percentage, we then have a target of, okay, what's the price that should match that percentage? And then we can look at, okay, currently of all of our assets, what does that currently reflect as far as dollar amount and percentage? And then how far off are we? And this can inform decisions about, hey, you know what? Let's say in this particular example, I'm short on US stocks hitting my desired percentage for my portfolio, and I'm short by $6,700. So I'm certainly not trying to add, nearly $7,000 of US stocks to my portfolio today, but I can go in and if I have like auto investments set up, then maybe I just go and change those auto investments ever so slightly so that by the end of the year or by the end of next year, my allocation of US stocks is going to be short up to what I want. And of course, those tweaks are going to be different based on where else are you tweaking your portfolio. But this is just a great snapshot to pull if you've never done a look at your allocation and you're like, how do I know this? A lot of times I'm showing you a spreadsheet, but a lot of times if you're just using like Fidelity or Vanguard, then you can probably just go into your dashboard in Fidelity or Vanguard and do something similar here. But the reason I have this spreadsheet here is because Fidelity and Vanguard don't have access to external accounts like your retirement account. They don't have access to whatever real estate holdings that you might have. So this is a great way to just be able to say, I'm going to throw all of these numbers into a quick spreadsheet and try and get a feel for like how accurate is my allocation based on what I want my allocation to be. So I just wanted to show you that really quickly, and I'll go back to this allocation check. I am happy to share that spreadsheet, and I can put that in our notes on this YouTube when we post it. But feel free to reach out to us if you have questions about that. one thing that I'm going to add here is we have a big picture look, and then we have like more of a lower level look. So big picture should include, like I mentioned, all accounts, including your retirement, brokerage, real estate holdings, other assets that you might have. Um, and because a lot of times, like you'll look into your Fidelity, say you have a Fidelity brokerage account, and you can get an allocation check based on your Fidelity brokerage. But that is not reflective of the big picture, right? So it is important to just make sure you have a check on not only each account, but your big picture. And then just make sure that your allocation aligns. One is getting clear on what you feel good about as far as the allocation that you want, and understanding that that could and should change slightly over time. Um, so, like for example, I have an allocation that includes small cap, so like smaller U.S. companies. And when I say companies, I'm talking about funds. I'm not investing in specific individual small U.S. companies, but funds that have smaller U.S. companies in them. And I tend to see a lot more growth there, but that is a riskier asset class. So over time, my allocation in those companies will shrink. And I, that's starting to happen at a higher rate now, based on where I am in my life. And my allocation towards, more stable US companies is getting larger and larger. And then one thing that I've changed recently is a slightly higher allocation in international funds, which means a slightly smaller allocation towards US funds, but nothing really, really drastic just yet, anyway. And when our allocations change, I want to emphasize too that these are like very slight changes. But unless you are like, whoa, I just realized what my current allocation is and I want to make some big changes, then that might be a reason why you'd see a big allocation change. Or if you're like, whoa, I'm totally freaked out by this one asset class and I want to make a big change out of it. So that could be a reason why your allocation might change a little bit more drastically, but we'll talk about how to go about making those changes because that really is important, having that strategy. And I do just want to make a mention of an IPS or investment policy statement because it's also nice if you're someone who likes to have a checklist or some sort of like script. You don't have to like come up with this idea and remember what to do every single time you're taking a review and check of your portfolio. You can have your own investment policy statement. I think it's a great thing, great document to have, and it summarizes your position of all of those things that we just talked about. So this is just something that you can pull up and be like, okay, let's just see where I was last time I did this. And do these goals still make sense to me? Is this timeline still right? Do I still feel the same way about this risk tolerance? So it's just a great thing that can guide you through a portfolio review, especially if you DIY your financial plan. For an investment policy statement, this is something that often advisors, good advisors will walk you through, and also just keep in mind about you when reviewing your portfolio, and should inform advisors, if they're helping you come up with an allocation. So getting into the strategy of how do we go about making changes, I want to emphasize here, I think also this is like, we're now bridging from, hey, great, you got familiar with your accounts, your portfolio, this big picture. That's a big step, first of all. I want to really emphasize that's something that I think is intimidating for a lot of people because it can feel like a lot, even just tracking down our logins for different accounts that we have, and just especially if we've gone through many jobs, if we're at a point in our career where I'm like, I have several different HSAs out there, and I have a lot of different retirement accounts from previous employers. And oh my gosh, like this is really intimidating for me to track all of this stuff down. So I want to acknowledge how heavy of a step that even can be. So even just getting to the point where we're looking at our portfolio as a whole, that's a big deal. And that's something you should congratulate yourself for doing, especially if you're doing it on a basis that I'm not even going to say just regular, because it sounds also like many of you are doing this on a potentially irregular basis, but a very relevant basis as far as the changes that you're seeing in your life. So that's a huge step. And I think that that's worthy of praise right there. Then there's a whole nother step about, okay, I looked at this portfolio and I realized there are changes that I probably should make. And that's a whole nother thing. And I know that that part can feel also very intimidating. So one thing that I want to say is it's pretty rare that we should be in a position where we're making massive changes. And it's like, oh my gosh, I have to totally like sell off this one fund or this one company's stock. So I want to encourage everybody to understand that when we might highlight that there are opportunities for changes in our portfolio, we have the ability to make those changes slowly over time. And that is often what's better from a tax perspective anyway. But taxes is one big reason why it's not a good idea to just like rush into making changes or doing them without thinking. It's really important that we're strategic when we make changes in our portfolio. If I'm in a taxable account, like my Fidelity brokerage, if I go and sell some funds, I'm going to have tax implications. I might have short-term gains, hopefully not. Hopefully I can look and figure out if I know that I need to sell things, I'm going to sell things that I've been holding, assets that I've been holding for at least a year. And I also have decisions to make, like Susan and I were talking about before. Are we harvesting gains or are we harvesting losses? And harvesting is just like what we mean when we say, are we going to sell something that for a loss or are we going to sell something for a gain? And you can have the same fund in your portfolio that you've bought at different prices over time. And even though like overall that fund has done well and you've made money on it, you might be in a situation where you're selling for a loss because at one point you bought shares of those funds when they were way, way higher than they are now. So that would be an example when you're selling for a loss. If you decide, hey, I'm going to sell these shares of that fund that I bought way back here when their price was a lot higher than they are right now. And so even though overall you've made money on that fund, you're actually harvesting a loss if you decide to sell those shares that are worth less now than they were when you paid for them. But similarly, you have the option to say, you know what, I don't need to harvest losses because a loss is going to help me reduce my taxable income and that'll save me money on taxes. But I'm actually in a position where I have already lower taxable income than I expect to have in coming years. And actually, that's the position that I'm in now, where I'm like, you know what, I could harvest some losses and like hedge against, potentially higher income and tax bill for 27, but maybe I should actually harvest some gains just so that I can create a little bit more breathing room in the future for me, and I can save myself the tax bill in the future. So you can also look back and say, okay, I'm going to take the shares that I bought like decades ago, and they were like way lower than the price of those shares today. And that's a long-term massive gain. And I'm just going to go ahead and realize that gain now. And yeah, I'll pay taxes on that gain, but I think that those taxes are going to be way lower now because the rest of my taxable income is going to be a lot lower this year than I expect it to be in future years. So those are examples of different strategies that you might be looking at when it comes to like, do I need to sell something? But the other thing is, if you're not comfortable with that, for one, that's okay. And that's why professionals exist. That's why Susan and I help our clients with that very frequently. But also, that's specifically in a taxable account. And you could always look to make changes outside of your taxable account, where you tend to have, you don't have to deal with some of these more strategic decisions. And it's easier for us to look into a tax-free or a tax-deferred retirement account and be able to make some of those trades without the tax implication.
And most brokerages allow you to decide what you're going to sell. So
Yeah.
typically the default is first in, first out. So the default, if you don't specify, they're going to sell your oldest shares. But you can actually go through, and I actually did this just this week. You can pick which lot of shares, like Caitlin was saying, that you want to sell. And so you can say, okay, I'm going to sell these shares that I bought 2 years ago versus the shares that I bought 5 years ago. And so you can do that to generate the kind of tax result that you're looking for. And so for me, I wanted to generate less gains because I need to get my tax bill down this year. So I wanted to choose a lot that had a higher cost basis. So I didn't generate as much capital gains on that. So I picked a different lot than just using first in, first out. A lot of brokerages also have an option that is tax optimized. You just click that button and it chooses which lots for you will give you the lowest tax bill. So you can do that too. So there are a lot of different options you can choose from when selling. A lot of people don't realize that and they just go with the default first in, first out, but you actually do have a lot of flexibility with that.
Yeah, totally. And then one last thing that I'll say about this is that if you have a large position that you're wanting to sell, it is okay to be patient and just sell that piece by piece. We can't predict what's going to happen in future years, but we can certainly say, you know what, right now I'm not comfortable with having a huge tax bill on just selling this one, big position on this fund. So I'm going to sell it piece by piece. And whether it's tax related or not, you might have emotional reasons too for not wanting to get rid of an entire position, and that's okay. So just want to remind you that it's okay to be patient. I think I've emphasized that again here. Takeaways or, being mostly hands off in our portfolio. That's not only okay, that's important because that usually can help us keep from being stressed out and making irrational moves and having a plan. So today we talked about goals, timeline, risk, values, allocation. Those are really important parts of our plan that really just keep us grounded when it comes to making decisions about whether things need to change in our portfolio. And then if there are changes that we think we need to make, it's okay to do those very, very patiently. Make sure you do them strategically. They could have pretty big implications, especially from a tax perspective. And if this is overwhelming, find an advocate too. Susan and I, Rising Femme Wealth, that's also what we do. We help our clients understand this process. We work with them on this process, and then we are there to help when they have questions. And so it can feel like a lot sometimes. You can do it, and if you want help, we're here to help. All right. By the way, if you've not met with us or if you want to meet with us again, this is our QR code if you're interested in booking a free strategy session with us, where we can talk you through the ways that we advocate for our clients and what we do from a planning perspective. So we're up on time. Thanks so much for joining. And if you do have questions that pop up, feel free to reach out to us. We're always interested in talking through questions. So thanks, everyone.
Yeah, that was great, Caitlin. Thank you. Bye.
Bye.